Earnings season is off to quite a start, right? The big companies that we've heard from thus far, the likes of Delta, the likes of Pepsi, and then the big banks like JP Morgan, Wells Fargo, and Citi, all of them come out and beat estimates. The question going into this earnings season is beating the numbers enough, right? We've had a lot of discussion about whether it is a low bar going into this season or a high bar for these companies, given that stocks have already rallied quite a bit going into this earnings season. I'm Julie Hyman. This, of course, is Brad Smith next to me, along with Myles Udland and Brian Sozzi, all of Yahoo Finance. We're going to talk a little bit about this earnings season and whether indeed the expectations are high or low coming into it. Brad, we've been putting this question a lot to investors over the past couple of weeks.
We have been, and now we have to answer it, at least based on some data here. FactSet said that the highest number of S&P 500 issuing positive EPS guidances since Q3 2021 is happening right now in advance of this earnings season, that data dropping from FactSet. It kind of tees up some of the expectations. We were speaking with Delta CEO Ed Bastian about what he's expecting this earnings season. Choppiness is the language that he used, especially given some of the demand that the travel industry continues to see persist, whereas in some of the goods-producing services out there, you could still see areas like appliances, like home goods and home furnishings, rather, apparel, footwear, electronics, that continue to sputter, and that's going to be interesting to see how the health of the consumer is talked about, as we've gotten some inclinations from bank CEOs to determine over the past couple hours this morning.
Yeah, I think what's interesting about this earnings season is that the headline number is expected to be bad again, even worse than it was last quarter in terms of year-over-year earnings declines for the S&P 500. But if you start to decompose that, you see that it's pretty much all about what's happening in energy, whereas this time last year, very good time to be an oil and gas major. Gas prices are very high, record profits for the likes of Exxon and others. This year, those companies are going to have very bad results. So S&P overall earnings expected to be down 7% in the second quarter. But look at sectors like communication services, look at sectors like consumer discretionary, and there we see earnings expectations for increases, double-digit percentages over last year. That's what's happening in the stock market right now. And I think what we are learning again, and maybe investors don't forget this, but maybe pundits like us forget this, that all that matters for the stock market is what people think earnings are going to be 1, 2, 6 quarters down the road. And that outlook, Saz, has started to improve, has been improving for some time. It really inflected at the end of first quarter earnings season. And to me, kind of everything we've seen in the stock market continues to suggest that investors don't think it is time yet to stop revising higher future earnings expectations.
Yeah, right on, Myles. I think we have to redefine what an earnings beat is. Back in the day, maybe 5 or 10 years ago, you beat by 2 cents, your stock price goes up, and that's great. But I think this week we saw PepsiCo come out, blow investors away with its earnings results. We had a very upbeat tone from CFO at PepsiCo, Hugh Johnston, on our network. They came out, raised guidance for the second time this year. Big. You mentioned your conversation with Delta CEO Ed Bastian. Big earnings beat, big outlook from the company. And if you want to go back further, we can blame this resetting of expectations on Nvidia. This company came out on May 24th and raised their sales outlook by $4 billion. I've been doing this for over 20 years. I've never, ever seen anything like that before in my life. And I think it raised the bar for a lot of companies, not only for companies like Nvidia, but many other companies.
Well, and I think what's interesting about that, so it's $4 billion. It's a 50% increase in the range they were expecting for, I think, current quarter revenue, if I'm not mistaken. Yes. And so in the way that last year, if you look at it, for all the big tech type companies, it was like, well, all these expectations need to come down, whether that was for your headcount, for your investments. I mean, look at kind of what happened with the copycat nature of the rolling layoffs that we saw at the end of last year. Now I think investors are waiting for all these kinds of companies to maybe grow into the bar that Nvidia has set. Nvidia is saying there is an additional $4 billion worth of capital expenditures available for us, and then you kind of tam it out. You say, well, that means there's $30 billion enterprise software wide. So then you go around the market and you say, well, you should get this much, you should get that much. Why haven't you, company X, revised up your earnings yet? And I know it's a little tangential to the conversation. Your morning brief this morning, Saz, on Amazon did make me think of sort of like, where's AWS in this? Where's Andy Jassy coming out saying, like, here's my $5 billion
Well,
beat?
the expectations for Amazon have certainly been raised, and it is not only for the second quarter, it's for the third quarter. You go to Yahoo Finance, type in Nvidia, go to the analytical section. We have all the estimates on there, and you will see that analysts raised their estimates for sales for the third quarter by $1 billion. So Nvidia not only reset expectations for the second quarter, they reset it for the third quarter, the fourth quarter, you name it. And unless Amazon is going to start selling generative AI chips, they might be in trouble.
But the AI elixir, as many have called it, it's not going to be the same this earnings period. In fact, the term that everybody was throwing out there in generative AI and how even a company like a Coca-Cola would use that. Who knew? Who knew that would get brought up in their earnings conversation as well last quarter? But this quarter, the term that's being thrown around even more so is resiliency. You're probably going to hear more about that. You've heard that from some of the bank earnings this morning, even how they describe the consumer right now. But what else might you hear? You might hear about normalization at the end of the day. You were describing how companies are going to have to prove the narrative that they put out there last quarter.
Yeah.
Well, in an environment of normalization, then investors are going to say, okay, what does that mean in terms of your own growth? And are you able to actually grow into that valuation that we were able to give you before?
Well, that's a good point about normalization, because that's something that JP Morgan actually talked about on the call this morning, right? When you look at something like credit losses, there's a lot of consternation about how many people are not going to be paying back their debts in this environment. And JP Morgan said, yes, it's going up. Yes, it's an area of concern, but it's just going back to where it was pre-pandemic. It is a normalization period. Also on the normalization front, and also on the tech side, the UBS call this morning on Microsoft, where it talked about cloud infrastructure spending and called out both Azure and AWS and said, it's not that things are going great, but they're not getting worse. So there, it's a more of a stabilization. So it feels like we're getting at least some of the commentary coming out, whatever sector you're talking about, is that we're still finding that equilibrium.
And I think what's interesting about, I was talking to someone about this offline earlier this week, about exactly what you were saying, Brad, about the resilience frame. And this point that every company went back to over the last couple of quarters, you could always say, macroeconomic situation, macroeconomic concerns. I don't know. It was tough environment out there. And companies are rapidly coming up to their earnings calls. Those prepared comments, how you want to frame it, the numbers are certainly baked. The framing of it is probably baked. That's probably been with legal and compliance for some time. But I don't think as a management company, Sozzi, you can come out in 2 weeks or next week, if you are, regardless of what industry you're in, and say, tough economic environment. We missed our numbers because the macroeconomic environment continues to be tough because, Brad, that resilience for the economy kind of flipped. Now it's just growth again. And so I don't know if you have the legs to stand on to say,
hell no.
I'm sorry I screwed up. It was actually the other guy.
It was the weather.
What we have seen
was.
this week, this has been the week of the everything rally. And your news team, Myles, described it or covered it perfectly with the CPI release. That set off a whole, I think, tone change in the markets where everything is rallying across the board because have we entered a sweet spot for the markets where you have...
Dare I say Goldilocks?
Goldilocks, yes, you can. You have inflation slowing down. You have companies like PepsiCo and JP Morgan calling out strong demand environment. Wow, that darn seems like a very perfect setup for investors to have more gains going into the end of the year, which means the market might fall.
Now, just a word of caution here. It is still very early in this earnings season, right? This is just a little itty-bitty beginning of it. We still have big tech to get through. We still have a lot of the big industrials to get through. We still have a lot of the financials to get through, for that matter. Consumer products companies, all of it, we still have to get through it. So there still could be
Rivian's not going to make any money. Lucid not making any money. But still, Nvidia's going to have a great quarter.
Not moving the entire market, right? Like Apple and Amazon and Microsoft and Alphabet are going to be moving the entire market. One quick note on Nvidia, too, as we think about the effect with which it landed last season. It is super late in earnings season. Just sort of thinking about the calendar. It's it's August 23rd is the due date for
they should report every week.
Nvidia.
The story is so exciting. Just release your earnings.
No one should even be at work on August 23rd.
No, they should be
closing the stock market,
checking out Nvidia,
having a Mai Tai or something.
But the flip in this too that you may see, and even as we get into some of those tech earnings, is where the business to business narrative is also continuing to move forward. If you come out and hear companies like Amazon, and especially in their AWS business, or Microsoft saying within their own cloud businesses that they are seeing some type of growth profile that they didn't even expect because some of the companies that they buy into or companies that buy into them are purchasing more, then that puts on a spending profile from a business perspective that says, all right, we're confident enough to redeploy capital.
And I think that gets to the conversation about how challenging it's going to be for management teams to figure out what the narrative is they want to put into market. Because again, last year, you could always just say IT spending is pulling back. Like you had 100% cover to be like, who knows about that environment, but I'm not sure that that's really going to hold anymore. And again, if it stops getting worse, to kind of the point UBS was making this morning, that's all investors have really been reacting to. Apparently that's worth almost 20% on the S&P 500 in 7 months.
Well, and they've cut all the fat, right? That's the other thing with all these companies.
Yeah.
I mean, even though there's some reports more recently this week that Microsoft is cutting a few more people, but overall, it feels like the bulk of the cutting within tech specifically has been done. So then, if things aren't getting worse, it's nothing but gravy, right, from here, at least in theory.
Yeah, and I think then we get to, okay, so if it's no longer just resilience, but it's an inflection in the business cycle, then we get to kind of one of my favorite subtopics in markets, which is do you have the right CEO for the moment? What moment are you in, and do you have the CEO for growth? Do you have, do you need defensiveness? Is that your executive? Do you need a wartime CEO, which was kind of what, the pandemic kind of brought to the fore? And I think a lot of companies right now, Saz, that, looked at the world one way, said, we got through the pandemic, we have the cost cutter in charge right now, we have the responsible leader, but does that person have the vision to get us through a new business cycle that is kind of starting anew here? Let's say it wasn't in a formal recession, but let's call 2022 a recession. So 2023, 4-year expansion ahead of us. Is this the right person to get us there?
Well, so Disney did all of those, so they hit the Bob button once again.
Right.
Yeah, where's the stock at? Did we talk about this yesterday? I feel like I was losing my mind. Everyone's like, Bob Iger, it's so great. Stock hasn't done anything.
Yeah.
But that's neither here nor there.
Bob Iger's pricing.
He doesn't need to hear it from me.
He's pricing Disney. But I'm glad you mentioned that because I'm going to give you another ticker for Josh Schaefer's look ahead column that hits on Sunday evening. That's Goldman Sachs earnings. When earnings come out, I think there's going to be a real more scrutiny on this report than the normal, especially with David Solomon. I think he's gotten a pass the past 2 quarters, but it is crunch time for that company. And there might be just a reawakening on what type of leader, to your point, a Goldman Sachs needs. So they need a company someone that comes up there and just cuts expenses, gets really faster out of businesses, because David Solomon, he's got a lot of L's on his time here, and the clock might be ticking.
Yeah, I know we always talk about the issue of the board composition, are they too close to these CEOs? It's always good for that conversation when we talk about should leaders be changed at the top of some of these companies.